Hey everybody, welcome to another episode of Capital Ideas, where we celebrate the ideas that enrich our lives and the capital markets that turn those ideas into reality. I'm Nick Morgan, the co-founder of ICANN, Investor Choice Advocates Network, and one of the co-hosts of today's episode.
I'm Mark Hiraidi, Senior Legal Director and Policy Counsel at ICANN.
And I'm Darrell Albright. I'm a co-host of Capital Ideas and a very proud board member of ICANN. And today we are joined by David Weild, the CEO of Wield & Co., the founder of the new Wield Foundation for American Competitiveness, and author of numerous landmark papers relating to capital formation. And Dave joins us today to discuss the current state of the capital markets. So thanks so much for joining us today, Dave.
And nice to see you, Dare. Dare is an old friend. So it's been when I was stumping and writing the stuff that led to the Jobs Act, but she was sort of one of my running buddies, if you will. So it's good to see you, Dare.
Yeah, it is great to see you, Jan, and your papers really did inspire a lot of my work over the years. So I appreciate that. Let's just jump in with questions. I mean, I think one of the things we want to talk about is the fact that seed valuations have gotten to unprecedented levels now, especially AI. We're seeing like these over $1 billion valuations at a seed level, which is incredible. And I would be curious to hear your insights in how these elevated early stage prices are basically rippling throughout the whole capital formation ecosystem and how it's going to affect IPOs in the future and what risks will that create both for the issuer side as well as the investor side.
As a very famous baseball player once said, deja vu all over again, where, we've seen these kinds of distortions all the way back. I'm going to date myself when the beginnings of the biotech IPO market, if you look at Genentech when it went public in 1980, which is one of the reasons why I came to Wall Street, this stock was priced around $30 a share, gapped open to 80. There was a surge of kinds of companies. And for me, that was capital funding innovation and having the potential to kind of allow scientists, engineers, and entrepreneurs solve the great challenges of our time. So that's why I went to Wall Street, because I wasn't, your typical mercenary investment banker. I actually had a social impact bent right from the beginning. But we started valuing companies because we didn't know how. We just knew there was potential. What Alan Greenspan, who used to be the chairman of the Fed, used to call irrational exuberance, right? And so we were valuing companies on the basis of multiples of PhDs in the life sciences market. Fast forward, and then all of a sudden we were in the internet bubble. And I remember, sitting on the commitment committee of Prudential Securities and then having this, discussion with the analysts about how, I know you guys are valuing companies on multiples of eyeballs, but this is a nonsense sort of statistic. It's you're rationalizing your way to the conclusion you need to reach because you're trying to justify what the valuations are. I think we're in a little bit of that with AI. Like to your point, Dara, it's not that the valuations in venture are so distorted. They're so distorted in AI, right? And I think about 50% of all investment dollars in venture right now are going into AI. What's going to come from the primordial ooze, just like it did from life sciences, just like it did comes from the internet bubble, and now the AI bubble, if you call it that. By the way, I worked on the NVIDIA IPO for Jensen Huang. I'll hold that out there. And, you're going to see a lot of good come from it, but it's going to settle out at some point here. And people are rushing in and there'll be a consolidation. A lot of these things will get snapped up and a lot of them will probably go out of business. But there's going to be some great good that comes from it in certain verticals in particular. And, my biggest concern with this particular bubble is the job displacement and that it's going to create. And I don't think we're very good as a country doing the reskilling that we need to do and running the transition. And I know we're going to get talking about the IPO markets, but I would tell you that we've got our flanks vulnerable right now without having the kind of IPO market that we had 30 years ago structurally, right? It's very different. And we need to get back to that because that's actually that's the accelerant, if you will, to new job creation and reinvention when people get thrown out of work. Okay. When you lose a job in this country, a lot of people sort of sit there and say, what can I do? And if I can't find a job, I start a business, and I need to be capitalized. And if I want to get more capital, equity capital available for people to start businesses, there's a lot of ways to do it. But one of the primary ones is lowering the hurdle at which you can take companies public, because that invites a lot of private money into, or public money to come into the private markets, because you have a higher likelihood of getting an exit in a shorter period of time. And so that's kind of the key missing ingredient right now to the economy. And I like to say that there's a lot of stupid that gets done with our regulators, and I don't do stupid. Okay. And I would sit there and say that, we never should have had one size fits all stock markets. And if you go back 30, 40 years ago, we had a one size fits all stock market that better served the needs of smaller, earlier stage companies. And then we flipped it and we created a one size fits all market that supports only large, innately liquid network effect stocks. Okay, these are the large cap stocks, and it actually decimates markets for small and micro cap companies, and particularly micro cap and then nano cap. And so, we've then shut the window on companies getting into the public markets in any kind of reasonable period of time. So the gestation periods now pre-IPO are probably 14 to 16 years, whereas once upon a time, of course, there's exceptions, whereas when I got into the business, they were 3 to 6 years. Okay, that's a sea change. And the irony of it is, it's probably cost the U.S. Treasury trillions of dollars. And the reason is, you've got the greatest tax mitigation, tax deferral market structure ever known to man. And our guys don't understand that. Okay. So that's one of the things with the Wield Foundation. By the way, it's wieldfoundation.org. We have to get back to writing and proving out, because, we can be so much better than we are as a nation right now. But because of ill-advised changes to market structure, which most people don't understand particularly well. Remember, our House of Representatives is the people's house. That was the way it was designed by our forefathers. And so very few of these people have strong economic backgrounds, strong market structure backgrounds. And so they need somebody that's going to put their red, white, blue epaulets on and tell them what's in the best interest of the country and why. And that's why we've been so successful. And actually, getting people to do things down there. I mean, the big tragedy, if you go back to the first Trump administration, we had a much bigger bill than the Jobs Act. And, and if you Google Father of the Jobs Act, I'm the only name that you'll see come up. Okay. That was the first pro-capital access legislation since the time of FDR, 1940. And I think, and we were talking earlier about the other acts that have happened, but those they're constrictive, right? That's Sarbanes-Oxley, Dodd-Frank. I mean, here in 2012, we did the Jobs Act. What did that give people? It gave them crowdfunding. It gave them emerging growth company IPOs, Regulation A+, which is essentially earlier IPOs with less disclosure requirements, and maybe even most importantly, which came directly from me, was Reg D 506C, which was the repeal of the prohibition against general solicitation. I think that came directly from a paper I wrote called The Wake Up Call for America, page 34. But it just basically said, why do we care who we talk to? We should be able to kind of broadcast all these great ideas that we have and let our children even learn about earlier stage companies. Allow Mark Zuckerberg pre-IPO for Facebook get on TV and talk about his company, right? That we deprive people of learning. And the other thing that we did with the Jobs Act, which gets lost on people sometimes, is that we changed the paradigm so that anybody could invest. And the way we because it used to be at the SEC, and I know you guys are both from the SEC at one point, it used to be you thought we're gonna just tell you can't invest in these things because they're too risky. And 4 billion years of evolution. And we learn by doing. We learn mostly from our mistakes. And so we deprive people of making mistakes. So the trick with the Jobs Act was to say, you can go out and take a shot at these early stage companies. Okay, but we're going to max out the amount that you can actually invest and lose so that it's not catastrophic to you. And we're then going to give you back your ability to learn by doing. Okay. And that was the beauty of the Jobs Act. And in fact, if you look at that theme, it actually is the foundation for what's now the Genius Act and the Clarity Act, that without what we did in the Jobs Act, you would not have these innovations that are now going on in the Genius and Clarity Act that are setting the stage for crypto and the current shift in the banking system that's going to go all digital. I mean, I don't know if everybody knows, but we're November 20th, and I think on the 22nd, the SWIFT system for bank settlements is being converted to digital.
I want to ask you about the IPO and the market structure, because you are the perfect person on. If you'll allow me, I'd like to take you back a little bit before the Jobs Act, because in 2010, you authored, it's really the seminal study called Market Structures Causing the IPO Crisis and More. And since then, you've been asked and presented to Congress, to the SEC, about all the reasons that, structural reasons that we haven't had a robust IPO market. So let me ask you, since then, what advances have been made to address the market structure issues that you so aptly identified?
Well, the one that was done, let me just step back and say the most important contribution of the Jobs Act was really that it started to create an ecosystem that we're barking from the town square saying we have a problem. And now you have people that are entrenched, that these businesses that never existed before, like Start Engine, the technology platform Core, which you'll see Core inside KORE, which is the company that actually provides all the compliance backdrop for Know Your Customer and other kinds of things in private markets. But Republic is another one of the big crowdfunding platforms, and so you kind of opened up the floodgate. One of the things that people don't understand is testing the waters came from the Jobs Act, right? And it allowed people to effectively talk to investors prior to even a public registration statement. So, I had a conversation, Mark, you remember Meredith Cross when she was running the SEC's Division of Corporation Finance, and I was at the SEC, and she asked me, David, what do you think about this great quiet period that we had at the time leading up to the IPO? For 6 months, you had to be basically under the cone of silence, not saying anything to anybody. And I said, Madam Director, I said, I think it's a great strategy if you're working for the Chinese. And she said, well, what do you mean? I said, I kind of thought you would say something like that. And I said, well, look, you got heavy IP companies like biotech. They're pre-revenue, okay? They're going into phase 3 clinical trials. And there's no institution that can do full due diligence on a company based on a 1 hour one-on-one meeting on an IPO roadshow. It's just not possible. And so consequently, they haven't de-risked it in their minds enough to know what the intrinsic value should be. So if it doesn't trade well out of the box, they deal with the risk. They figure they missed something. They flush the position. It drives down the price. And so you see a stock that, got priced at $10 a share, now trading at $3. And it's destroyed sort of the cost of capital for that particular company. And so what we did with the Jobs Act is we kind of exploded the number of crossover buyers. So if you look at the growth in bona fide public institutions that set up crossover funds and how many of them show up on cap tables, from Fidelity to T. Rowe Price to Wellington, and then on the life sciences verticals, you'll see the big vertically integrated funds like Deerfield, Orbimed, and Perceptives involved. What that does is that when you now look at an S1, which is the document that we take do a full blown big boy, big girl IPO from a fully baked company. And you look on the cap table, you'll see people that have bona fide public market expertise, and that have research analysts that really had an opportunity to kick the tires, that showed up in a pre-IPO round. And that credentializes the company. That creates an imprimatur. It tells people that real due diligence has been done. That creates a good housekeeping seal of approval. And that causes other funds institutionally to flood into it, and to have more courage that the work has been there, because those accounts that I just said have a private market position they can't trade out if they're going to be in it for the long run. So it creates a little bit of sponsorship that otherwise wouldn't have existed. And that was probably one of the most transformative things of the Jobs Act that's probably not particularly well understood by people. But the other big one is this ecosystem of a cottage industry of people out there that are out soliciting investments for startup and early stage companies online, and now going down to Congress and looking for earlier stage, improving the exit markets and improving these markets in general. And so, as I like to say, they knocked us down, they put us on our back, and we're clawing our way back to where this country should be, which is a country of entrepreneurs and people that are grabbing for the American dream, right? And doing it in a legal and compliant way that makes sense, and learning at an earlier stage so that they become better entrepreneurs as time goes on, legions of better entrepreneurs, because they were allowed, even as young people, to make mistakes, whereas before that we had deprived them of the ability to make mistakes.
Yeah. Let me pivot for 1 second. You just started to get into the sort of aftermarket issues that are out there. What about aftermarket support? I think there's a widely held perception that the lack of aftermarket support has plagued smaller issuers. Was there something in the Jobs Act, or has there been anything sort of statutorily or regulatory wise?
No, that's the big missing link right now, Nick, and that's why we need a new stock market with a different market structure. And we actually, the great legislative tragedy of it was in 2018, which was the first Trump term, we had a bigger bill even than the Jobs Act that went through. It went through and it got passed 406-4. Now, you can't even get a proclamation in support of motherhood and apple pie through the U.S. Congress 406-4. It was remarkable. And it included an act that was a bill that I worked on with Congressman Emmer of Minnesota and his staff, which was called the Main Street Growth Act. It was a venture exchange. And so, what I would tell you is there is no aftermarket support in micro cap, small cap companies. And I'm defining micro cap as sub $500 million, okay, in market value. None. And there's really de minimis under $1 billion and under $2 billion, right? And in fact, what you find today is that there's no money in penny tick size markets for people to go and visit institutional investors. So if I was to, whereas they used to be, they all were on a first name basis, right? They were up at Fidelity, visiting Fidelity. They were in, at T Rowe, constantly. Now, if you do a poll and you say to a big buy side analyst, meaning an institutional investors analyst who's covering, for instance, software as a service, and you ask them, who's the best analyst institutionally in software as a service or semiconductors or life sciences, doesn't matter. And they will look at you and they will say, I don't know any of the analysts. They used to know them all. Okay. And the reason is no money in the business, and they've devalued the research because of regulation, fair disclosure, right? And so, you're now, there's some really pernicious, really, really horrible side effects of this market that people don't understand. Our big bulge bracket firms tell companies that are going public, these are larger, more fulsome technology companies, that they need to see a 40% pop on the first day of trading in order for it to be a success. Well, guess what? They've just journaled 40% value. And it's one of my great pet peeves with people in Congress is they're always worried about the 7% gross spread. Well, wake up, everybody. 7% is trivial compared to jamming somebody into having a 40% pop on the first day. What's that all about? The only alpha that Wall Street can deliver to the major institutional funds today, since Reg FD, is underpricing equity offerings. Okay, and so we make them work by underpricing them, and then also focusing them and their distribution into 60 institutions that they cover out of their institutional equity sales force. There's only 60 accounts that a typical institutional sales group covers. And within that, and the reason is very simply that of the 60, they represent 90% of the commission pie of Wall Street. So there's another 3,000, 4,000 accounts. You can't really make a living when 10% is of the remainder is spread across the rest of it. So they don't cover them. So if I go into a bulge bracket firm, that's the, Wall Street speak for the largest of the large. So it would be, firms like Goldman and Morgan and, Merrill and, and Credit Suisse and UBS and so on and so forth. You will find that if they have a middle market institutional equity sales desk, it's 5 guys covering 2,000 accounts, and they're order takers. They're not making outbound phone calls. Okay. And so when you look at it, what do you see in terms of characteristics of those institutional accounts is they hit one of two categories, right? They have ridiculous amounts of assets under management, with BlackRock being another case in point. And by the way, I raised the first money for BlackRock. The name BlackRock comes from me. I actually named it with Ralph Schlossstein, who was the co-CEO to Larry Fink when Schwarzman, it was originally called Blackstone Financial Management. They were spinning it out, and Steve Schwarzman wouldn't let them keep the Blackstone name. So we had all this money percolating out on the retail side, and we didn't want to confuse the market too much. So we came up with BlackRock as the new name, and it's now the largest. I mean, literally, when I started working with them, they had no money under management. They're now the largest asset manager in the world. So, so you look at it, and so you have these ultra large institutions. BlackRock's got trillions under management. They can't trade a $500 million market value company, own it. Okay. It's just, they can't put enough money to work, right, in the public markets. And so what are they going to do when they get an allocation, but they're going to blow it out into the aftermarket? And then you have the other subset of accounts. Like you ask the question, you should ask the question, what are the characteristics of those top 60 institutions that generate 90% of the commission pie? The other one is their hyper turnover, hyper churn. So their idea of a long-term holding is buy on the open, sell on the close. Okay. So we have this complete misfit because we don't have adequate economics in the long tail of the smaller accounts that are the right home, that have low churn and are doing fundamental investment. Nobody's talking to those accounts. And that's the market you need to reach to be successful as a smaller company. And we're not set up to do that. And it's complicated by the fact that Wall Street runs around and says, because they want you to pick me, do your deal. And they don't want to tell you the truth that they're not providing any aftermarket support. Okay. It's one of the greatest lies on Wall Street today is we provide aftermarket support. They put a research opinion up. It goes into a portal. Somebody may or may not look at it. It's not actively marketed. Nobody's making an outbound phone call to create a buyer to offset a seller when it comes into the market. And as a consequence, you have all the fundamental money tends to flee these markets. Or if they're in there doing their own fundamental research work and they run a microcap fund, with somebody with $1 billion or something under management, they're looking for things that are significantly underpriced that they can hold for the long run. And even then, a lot of times they don't want to buy them in the open market. They'll buy it through a PIPE transaction, private investment in public equity, to establish a position because they know, because of the illiquidity, that if they go in and they try and buy it, they may move the stock, create slippage, right? So you've lost all the institutional liquidity in these micro cap names. If I have to get size done, right, what's going to happen? I mean, everybody's out there sniffing, trying to figure out what I do. I got 1 million shares to go at $10 a share. And then all of a sudden they see a little bit of volume and then people pound on it, start shorting it, knocking the stock down. And before I know it, I'm getting out of my position at $7 a share. Well, that destroys your returns. So what the institutions have done is they've gone up market to find where there's natural liquidity. And even then, you put a lot of this stuff in the electronic wood chipper, bleed it out to the alphabet city of the 50 ATSs and ECNs that are out there. If you go back to the Flash Boys book with, Brad, that was written about Brad Katsuyama, and he was the one on the, also 60 Minutes did a piece of slowing down and connecting all of the fragmented markets out there so that you could take out the bids all at once for a long only investor like a T. Rowe Price to try and get a little bit more size done. Because why? Because people would see these things go off in the market. And if you didn't if you didn't have them hit each of the venues, the trading venues simultaneously, they would get ahead of you elsewhere and front run your trades.
You mentioned the Wield Foundation for American Competitiveness, and I wanted to congratulate you on launching it. What initiatives is the foundation undertaking right now to strengthen U.S. capital market competitiveness?
Well, we're launching it on December 1 formally. So you're going to start to see, emails and solicitations. It's tax deductible, by the way. So it's an educational foundation and think tank. And what we're really trying to do is to create the content to educate, policymakers, regulators, to change that. I say, if you change the discussion, you can change the outcome. And so my superpower is, because I was a former vice chairman of NASDAQ, if I write something, it'll be read on the Hill. And I write it in a way which is geared towards, congressmen. So I'll probably never get a PhD for what I write, because that stuff doesn't get read by Congress and by the SEC and others. And so we're just really about trying to educate people about these horribly complicated systems and understand the cause and effect of, as we think it, ultimately all the way down through the economy, U.S. competitiveness, the ability to compete against China. I think that what I see is a lot of conventional wisdom from amateurs that creates these unintended consequences that deprive the Treasury of tax receipts, that deprive the economy of job creation at a time when we're probably going to need it more than ever because of the displacement that's coming down the pike from AI. And then there'll be a subsequent wave of robotics. And what I think is the foremost and most important part of the economy to innovate and solve problems that face mankind, from climate to healthcare to you can just name the problem. And so, I like to call myself a free markets collectivist, which is to some degree an oxymoron, which is to say that, if you research it, there's a school of economics called free markets, and there's a school of economics called collectivism. And I think that I'm a staunch believer in free markets to solve problems. You just have to get the carrots in the right place. And right now, our carrots are in the wrong place. And I think that if we get them into better places, stand away and let the free markets work their magic, and we'll solve all sorts of problems. And from improving our tax receipts. Look, we'll talk about economics for a second. I think that the unemployment rates and labor participation rates and the way we calculate them are the participation trophies for economists and policymakers and politicians, that they're incredibly misleading. And I would just tell you, little idiosyncrasies of the numbers, if you really dig down and look at how they're calculated. If you incarcerated 100% of the US population, your unemployment rate would be 0%. Okay. And that's ridiculous. And it's ridiculous. Okay. If you start to look at, you take caregivers out of the denominator. Okay. Well, guess what? We have an aging population right now, and there's going to be a lot of people that get pulled into caregiving, elder care. And as a consequence, it's going to artificially cause our labor participation rates to look like they're going up and our unemployment rates to look like they're going down. It's madness. Okay. What we need to do to structure an economy that works for the people is to make it work in a way that people can work, that we're all going to have. We've got this massive deficit of $2 trillion a year. We have to figure out how to pay it down. And that means that people at my age are going to have to work longer. And that means we're going to have an employment market that actually employs people my age and older.
What you've described as the mission of the Wield Foundation for American Competitiveness, I think it's a great mission and something that maybe we can collaborate with you on once you get it up and launched. Remind us again what the website is.
It's wieldfoundation.org. Very simple. So Wield, W-E-I-L-D, foundation.org, all one word.
Let me close with this, David, because you've said a lot of things. I think there are a lot of securities and capital markets policy issues that could be solved. But if you had a magic wand and maybe you will be with your foundation. You will be wielding a magic wand. What is one policy change that if you could implement it tomorrow?
We
Yeah.
need legislation for a small IPO market that takes companies public in 3 to 6 years. We would 10x the IPO market if we did it right.
Yeah.
And that would bring $500 billion into private markets over time. It'll take a while because, these require broad ecosystems to be built around changed incentives, and that will create lots of innovation, lots of job formation, and the ability for the economy to kind of reinvent itself when we go through these major dislocations through technology shifts like AI and quantum. And that's in a sense, that was the essential thing that we had years ago, going back to the 1980s, that made the United States' capital markets the envy of the rest of the world. And we changed it. We got rid of it, frankly. So we need to bring that back. And, look, I'm going to go to my maker getting that done. I mean, I honestly think we can get it done. We got close to it in the Trump administration. And I think that there's consensus, but as you guys know probably better than I do, that the challenge with legislation in this country is that every 2 years we change congressional cycles, we zero out whatever was in the queue, right? So if something went through Congress 406 to 4 that was incredibly, insanely bipartisan, that, you need somebody to pick it back up because the old sponsors, they changed responsibilities. It gets lost in the dustbin of history. And so that's why the foundation is there, so that we can take the really good ideas and pick them back up and work them through congressional cycles, educate until they get done, because it's absolutely essential to the well-being of every one of our kids and grandkids that we do this. Otherwise, they are not going to have the opportunities that you and I enjoyed. And it's frankly not fair. It's not who we are. If you care about the country, it's a have to do, not nice to do.
Yep. Well, excellent. We wish you the best of luck. It sounds like a great objective. Please keep us posted on the launch. We want to hear more. We want to work with you and help make the capital markets better. I think we'll leave it there. David, thank you so much for being on. Dara and Mark, as always, thank you for co-hosting. For everyone else, if you want more information about ICANN, go to icanlaw.org, and we'll see you on the next Capital Ideas.